Is the stock market close to a crash, or at least closer to a crash than you may think? I'm going to explain this to you in one simple, fast step. Step number one, let's go over negative real rates. This is really the catalyst to most people's thinking right now, at least most of the talking heads on CNBC and Bloomberg. And before we get into this chart that is going to absolutely blow your mind, I want to remind everyone watching right now that the yield curve on the treasuries has inverted. The euro dollar futures curve has also inverted. And today we got the news that the US economy actually contracted by 1.4% in Q1 of 2022. Very ominous sign when you combine that with all the other data points. But let's get into this chart I was referring to. Chart of the Fed's BS or balance sheet, whichever you prefer. Going back to 1940. This chart ends at 1950. So just the decades of the 40s. And on the left, we go from 20 billion, imagine that, 20 billion with a B, up to 60 billion. For those of you who are new to the channel, the Fed's balance sheet now is around 9 trillion with a T. But back in the good old days, we went from 20 billion up to maybe 30 billion from 40 to 42. And this is during World War II, or right at the beginning of World War II. And then we have price controls from 42 to 46, or maybe into 47. More on that in just a moment. But then the Fed's balance sheet goes straight up to about 50, 60 billion in 1946. And then going into 1950, it's right about the same level. But this isn't the most interesting part of the chart. Let's look at this green line that goes up. This represents what the CPI was between 1946 about, and we'll call it the end of 1949. And in 1947, the CPI in the United States got up to 19.5%. Really an astronomical number. And this was a result of there being price controls for so long, which, as you guys know, Economics 101 means the supply will go down. So when those price controls are lifted, the demand is still there. The demand, in fact, actually increases. Supply very, very low. Prices shoot higher. So you would assume if the CPI was running at almost 20%, that interest rates on the long end of the Treasury curve would be sky high as well, very similar to what we saw in the 1970s. But you would be wrong. The Federal Reserve had a cap on long-term rates. They capped it at 2.5%. That is indicated by this black dotted line. So Treasuries, at least the long bond, was pegged at 2.5%. So that means that the delta between the long bond and the rate of inflation was negative 17%. So the yields, the real yields, were negative 17%. Again, just a mind-blowing number. But I'd also like to point out that although we peaked at 19.5% in 47, by the time we got into 1949, going into 1950, the CPI was deflationary. The CPI was a negative 3%. So I'm not saying that the CPI went down by 3%. I'm saying it went all the way down to zero and then into negative territory where we had 3% deflation. So the first question is how? How on earth could inflation actually come down while we had negative 17% real yields? And you may be saying to yourself, okay, George, I get it, but what does this have to do with the stock market? Well, most of the talking heads on CNBC and Bloomberg would have you believe that if we have negative rates, then it's almost impossible for not only the CPI to come down, but also asset prices. And I want to point out that during the 1940s, we had significant deflation of the CPI and the S&P 500. Check this out. The S&P 500 from 46 to about 49 went down by 50% in real terms and 25% in nominal terms. That's when you don't adjust for the rate of inflation. So my main point with this chart is to show that we can absolutely have deflation in not only the CPI, but in asset prices with negative, right here, real yields. So currently in the United States, the Fed funds rate is in this range between 25 basis points and 50 basis points. And the CPI is humming along at about 8.5%. So we've got at least 8% negative yields right now in 2022. But there are some more similarities between what we're living through right now and what they lived through back in the 1940s. Editor, let's go ahead and cut to the internet. I want to start by looking at a chart of CPI and M2 money supply. What's really interesting about this chart is first it goes back to 1800, which is great, but it shows us a 10-year annualized percent. So let's go back to the 1940s, which because this chart has so many years in it, is represented by a very small sliver on the chart. You got to use your imagination, but it's got World War II here. So this is the beginning of the 40s and then and then 1950s. So you can see right there. Okay. So the M2 money supply is represented by the red line and the red dots. And it got up to, call it, 12.5% increase. But this would have been annualized over the last 10 years. So the rate of M2 money supply increase in this 1 year alone would have been much, much, much higher. And of course, it's the same thing with the CPI. It maxes out at about, call it 6% on this chart, but we know going back to the whiteboard that it maxed out at 19.5%. So this is just kind of an average of the last 10 years, of course, 10-year annualized chart, just like we said. So we know that the M2 money supply skyrocketed in the 1940s, especially in the early 1940s. And this makes a lot of sense because the government was spending huge deficit spending. It took debt to GDP up to about 120% from a very low number to begin with. And they spent so much money on the war that this filtered into the checking accounts or the balance sheet of the non-bank entities in the real economy and the banking entities, and this makes M2 money supply go parabolic. Very similar to what we have seen today, or at least since 2020 in the United States. The stimmy checks, the deficit spending, it's not for World War II. You could say it could be the war on COVID, but exact same thing with M2. It goes straight up, goes parabolic. So when you combine that with price controls, it's no surprise that the CPI went up to 19.5%. But then remember, it comes back down to a negative 3% closer to 1950. Why? The only conclusion that you could come to is the government was creating far less money through their deficit spending, and the supply shock from the price controls worked through the system. They created more supply of stuff, therefore the prices came down. So when you're trying to figure out if we're going to have more or less inflation, consumer price inflation, in the future, you've got to look at the demand side of the equation, how many dollars are being created, how much M2 money supply is increasing, but you also have to look at the supply side of the equation. Another great example is the late 1800s. M2 money supply went way up then as well. But what happened to the CPI? It was actually negative. So we had deflation while we had a significant increase in M2. Why? Because we were creating a massive amount of stuff. We were creating more and more and more goods and services because of the Industrial Revolution. We were creating so much stuff that it outpaced the level of the monetary increase. Then you fast forward to the 1970s, and everyone knows we had massive inflation there. And so you see the red line go up, which you would expect because M2 money supply goes up. There, the CPI goes up at the exact same rate. Why? Most likely because we weren't able to create enough stuff to keep pace with the level of M2 increase like we did in the late 1800s. So in the 2020s, you've got to ask yourself, how many currency units is the government going to create through deficit spending? What's going to happen to M2 money supply? But also, what's going to happen to the supply side of the equation? Are we going to be producing more stuff or less stuff? So you can see there are a lot of variables when we're trying to figure out price inflation and if assets are going to go up or down. And for those of you watching, I'd pose a question. Are we going into the 1940s or are we going into the 1970s? If your answer is we're going into the 1940s, I'd remind you that all those talking heads on CNBC and Bloomberg are saying that it's impossible that we see deflation, or it's impossible that asset prices like the S&P come down as long as we have negative real rates. Just take them right back to the chart of the 1940s, where we had negative 17% real yields with the long end of the curve and the official CPI. And at the same time, we had deflation of 3% going into 1950, and the stock market down by 50% in real terms, but even in nominal terms, it was down by 25%. So like we said at the beginning of this video, we've seen an inversion of the yield curve, which almost always leads to a recession. And Q1 GDP just came out the other day for 2022 at negative 1.4%. We're staring right into an economic recession, if not a global economic depression. And like we've seen back in the 1940s, even with negative real yields or negative real interest rates, the stock market can definitely crash. So for those reasons, my base case is that we are much closer to a stock market crash than you may think. Or we're much closer to a stock market crash than CNBC and Bloomberg would lead you to believe. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.